Hey everyone, welcome back to UJXanti. In this series, we try to understand whether the current rally of Bitcoin resembles more with 2019 rally or it resembles more with 2020-2021 rally. You may know that these two rallies, the bear market rally of 2019 and the parabolic rally of 2020 and 2021, had many differences. And we discussed the main differences in this series. And you can find the links to those videos in the description of this one. And today we are going to summarize our findings. So we are going to connect the dots. Here we have the 10 main differences that we looked at in this series. And a lot of things here are intercorrelated. For example, monetary policy, Ethereum Bitcoin valuation, Bitcoin dominance, gold breakout, yield curve inversion, and M2 growth rate. All these are very correlated. And one explains the other. For example, chances are high that gold breakout happened because of high interest rates and quantitative tightening cycle. The same happened in 2019, the same happened in 2024. And Bitcoin dominance increased in 2019 because we had QT and high interest rates, and the same happened in this rally. And QT and high interest rates were the primary reasons for that. The same goes with Ethereum Bitcoin valuation. Ethereum underperformed Bitcoin in 2019 rally, and it did the same in this rally. It underperformed Bitcoin. It went up in USD terms, but in Bitcoin term, it went down, which is not the case in 2020-2021 rally, because here we had quantitative easing and 0.25% interest rates, basically zero, the lowest that we have ever seen. So that's why a lot of things are intercorrelated and one can explain the other. And let's start with the monetary policy, because I believe, and I guess most of you will agree, that monetary policy can explain some of the other points that we looked at. So if we start with monetary policy, we also separated monetary policy tools. We had interest rate and we had QE versus QT, or in traditional terms, we call this open market operations. So from the monetary policy perspective, it was very similar to 2019. And is the same for interest rate, because in 2019, we had quantitative tightening, the same that we have here in the current rally, the current environment. We had high interest rates. The Federal Reserve had a interest rate hiking cycle in 2019. Actually, they started, of course, sooner than that. They reached the terminal rate in 2019. The same goes with the current rally. They started interest rate hiking cycle in early 2022, and they reached the terminal rate in 2023. Most probably the terminal rate. You never know, maybe they will hike again. However, Jerome Powell told that the chances are low for that. So these two, interest rate and QT, were kind of identical in 2019 and in the current environment. Of course, the magnitude was much different because we had 2.5% interest rate in 2019. That was the terminal rate. And currently we have 5.5% interest rate. And QT is much more severe in the current cycle. And that's because of the 40% increase in the M2 money supply. All right, we discussed these two. Then we have another macroeconomic indicator, which again clearly shows us that it's similar to 2019 scenario. In 2019, the 3-month and 10-year yield curve was inverted. Long before the recession, it has nothing to do with the COVID recession. It was inverted in 2019. It showed that the economy is not healthy and the bond market is not efficient, and it was primarily the result of the monetary policy because of the rate hiking cycle and quantitative tightening. And we have the same in 2024. The yield curve was inverted back in 2022, and it's still inverted. Both the 10-year and 3-month and 2-year and 10-year. Both of those are still inverted, and remember, those are lagging indicators. Inversion doesn't matter for recessions or for harsh economic conditions. When they uninvert, that's the time that recessions start to materialize. That's what history showed us. And they are yet to uninvert. And then we had gold breaking out of its multi-year resistance zone, both in 2019 and in 2024. And as you may know, gold investors start to increase their gold allocations. Not only gold investors, a lot of people that don't even have gold, they start to buy gold or increase their allocations when the environment is uncertain and when conditions are not very optimistic. They prefer to have their capital in gold rather than equities or bonds or crypto. And again, I believe that monetary policy is the primary reason that we had gold breaking out of its multi-year resistance zone in 2019 and in 2024. And again, this is clearly showing us that this rally is similar to 2019 from the perspective of gold breakout. And again, this is because people just seek safety. They just want to have their capital in the safest asset. And gold is very resilient during recessions, during harsh macroeconomic conditions. That's why a lot of people bought gold or increased their allocations. Then we have Bitcoin dominance and Ethereum Bitcoin valuation. These two are similar because if Bitcoin dominance goes up, it means that Bitcoin outperforms the general altcoin market, and including Ethereum. And this chart tells quite a similar story, Ethereum Bitcoin valuation. When Ethereum Bitcoin valuation goes up, it means that Ethereum outperforms Bitcoin. And remember that Ethereum is the proxy for the general altcoin market. Although some people consider ETH to be a blue chip, not an altcoin, however, Ethereum still is a very good proxy for the overall altcoin market. Usually, if Ethereum outperforms Bitcoin on consistent basis, altcoins start to outperform Bitcoin as well, the general market of altcoins. And when Ethereum underperforms Bitcoin, altcoins follow the suit. That's why Ethereum Bitcoin valuation and Bitcoin dominance tell similar stories. They tell the same story in different ways. And in 2019, when we had Bitcoin rallied in USD terms, and it rallied for more than 300% in 6 months. In 5 months, actually, yeah. And in this period, Bitcoin dominance increased, meaning that Bitcoin outperformed the general altcoin market. And in the same rally, Ethereum Bitcoin valuation went down. Again, meaning that Ethereum underperformed Bitcoin. Bitcoin outperformed both Ethereum and the general altcoin market. The same happened in the current rally. Bitcoin dominance went up dramatically, And Ethereum Bitcoin valuation went down. Bitcoin again outperformed Ethereum and the general altcoin market. And again, I believe that the primary reason for this was the risky and uncertain environment and conditions that we have. Because of the high interest rate and because of the quantitative tightening, investors are not very optimistic. They don't want to take on more risk for higher potential rewards. If everything is good, if you look and all the conditions are very optimistic, like we had in 2020 after the recession when the QE started, there will be higher demand for Ethereum and the general altcoin market than for Bitcoin. You will just take on more risk to get higher rewards because everything seems to be very optimistic. You don't have concerns. However, we have a lot of concerns. We had it in 2019 because of the QT, because of the higher interest rate, because the yield curve was inverted. And we have it here. In fact, we have higher risk for geopolitical escalations, which we didn't have in 2019. That's why Bitcoin again outperformed altcoins, the general market, and Ethereum in this rally, indicating that yes, Bitcoin rallied 300%. However, the environment is still risky and uncertain for most of the investors. And they just prefer to have Bitcoin, the safest crypto. By the way, this logic works not only in crypto, but also in equities. As you may know, 493 stocks out of the S&P 500 underperformed the top 7. Again, we have a few blue chips, and then we have mid caps and small caps. And people just seek safety. They just want to hold stocks of Google, Nvidia, Amazon, and they just don't want to have some small caps. That's why it indicates that the environment is risk off. The demand for safer assets is higher than the demand for riskier assets because of the uncertainty, because of the quantitative tightening and the interest rate, and overall because the optimism is not at the same level as it was in 2020. That's why this rally is very different from this rally. 2019 and 2021 are very different rallies. It doesn't mean that we are not going to get something like 2021 rally. I hope we will, because eventually QE will start, eventually interest rates will go to close to zero, and yield curve will uninvert, and the environment will again be more similar to 2020. However, the current rally from these perspectives resembles more with 2019. So Bitcoin dominance, it increased in 2019 rally, it increased in the current rally, indicating that the current rally is similar to 2019 rally from the perspective of Bitcoin dominance increasing while Bitcoin USD goes up. That was not the case in this rally. In 2021, in 2020 to 2021, Bitcoin went up in USD terms. However, Bitcoin dominance plummeted because there were higher demand for the general altcoin market and for Ethereum than for Bitcoin. And the same goes for Ethereum Bitcoin valuation. In the current rally, Ethereum Bitcoin valuation went down. Yes, Ethereum went up in USD terms, however, in Bitcoin terms, it went down. The same happened in 2019. Bitcoin rallied 300%. However, Ethereum Bitcoin valuation went down. However, the same didn't happen in 2020-2021. Ethereum Bitcoin valuation went up, meaning that Ethereum outperformed Bitcoin, which also means that the demand for Ethereum was higher than for Bitcoin. And probably this was because investors were optimistic. The uncertainty level was much lower than we have in the current environment. We had QE, in fact, the largest QE round ever in the history of the US. Interest rates were practically zero. We had 40% growth in M2 money supply in only 2 years, from 2020 to 2022. And that money should find its way into markets, into stock market, bond market, commodities, and crypto was not an exception. That's why this rally was quite different from the current and 2019 rallies. And another macroeconomic indicator that we discussed was the growth rate of the M2 money supply, the year-over-year growth rate. And as we saw in the video dedicated for this topic, we had three different scenarios and conditions in each of these three periods in 2019, 2020 to 2021, and 2023 to 2024. So the picture is less clear here, and we cannot directly compare the current rally with 2019 or 2021 from the perspective of the growth rate of the M2 money supply. That is because in 2019, the M2 growth rate was close to 4%. It ranged from 3 to 5%, which was the average rate in the last 30 years. So it was just a normal growth rate for the M2 money supply. Then in 2020, when we had the COVID recession, the Federal Reserve started its biggest QE round ever. And the Treasury gave stimulus checks to its citizens. As a result, the M2 money supply growth rate skyrocketed and it peaked in 2021, close to 28%. By the way, that was the highest growth rate of the M2 money supply in the history of the US. That's another reason that this rally was a little bit different. We had normal levels of M2 growth rate from 3 to 5% in 2019, and we had higher than 20% for almost all this rally for more than a year. And we had 28% in 2021. And when we come to the current rally, M2 growth rate went into negative territory in late 2022. Currently, it is in positive territory. The year-over-year growth rate is close to 1%. However, it stayed in negative territory for over a year. And this is another extreme. We had the highest growth rate of the M2 money supply in 2021. And we had another extreme, which was the second lowest M2 growth rate in history. In 2023, the M2 growth rate bottomed close to negative 6.2%. And that was the second lowest in the history. And this was the first time since the Great Depression that the M2 growth rate went into negative territory. That's another extraordinary thing. It's the opposite of 2021. We had 28% year-over-year growth rate, and we had negative 6.2% of M2 growth rate in 2023. Yes, currently it's 1%, and it's positive 1%. However, remember that everything in macroeconomics works in lags. And the effect of negative growth rate of the M2 money supply will not be felt immediately. Similar to QT and high interest rates, the difficult conditions will be felt after 12 to 24 months. That's what academic papers show us. And one might argue that we already see some signs of weakness in markets. That's certainly the case in crypto. In Bitcoin's case, we see that Bitcoin traded close to 74K in March. That was the new all-time high for BTC. However, we are down for more than 25% after that. Altcoins plummeted more, the general altcoin market. And one of the reasons that we had a lot of new all-time highs in 2024, Bitcoin, Nikkei 225, S&P 500, gold, all of these assets saw new all-time highs in 2024. And one of the reasons for that, and one of the reasons that almost all of the markets are not weak because of these QT and high interest rate cycles, is that the Treasury runs expansionary fiscal policy. They increase the level of liquidity. The Federal Reserve wants to decrease the level of the liquidity in the markets in order to combat high inflation rates. However, the Treasury does the opposite. And remember that the Treasury is part of the Biden administration and the Federal Reserve is not. They are independent body. And the Treasury has incentives to have better stock market. They don't want to have a recession before elections, surely. They will do anything to avoid it. If they expect that there might be a recession or economic contraction, they just can delay it by having expansionary fiscal policy. So the Federal Reserve tries to combat high inflation rates by cutting the liquidity levels in the markets. And the Treasury does exactly the opposite. They boost the liquidity levels. And that is one of the reasons that the markets are very strong during these QT and high interest rate cycles. And that's one of the reasons that we had new all-time highs for many assets in this year, including Bitcoin. Of course, we had many other reasons. That's not the only or the primary reason. However, it contributed to it massively. So for the M2 growth rate, we have three distinct scenarios and environments. However, in 2019, it was just normal average growth rate of the M2 money supply. In 2021, we had the highest growth rate ever. And in 2023, we had the second lowest growth rate ever. Two extreme, extraordinary cases in 2021 and in 2023. Very opposing scenarios. That's why we cannot compare the M2 growth rate, the current M2 growth rate, to 2019 or to 2021. That's why we are going to have blank for the M2 money supply growth rate. Because we have three different and distinct scenarios and conditions. The current environment for the M2 growth rate, the current condition, cannot be compared to 2019 or to 2021. Then, when it comes to all-time high, we differentiate two types of all-time highs, and that's real and nominal all-time high. Nominal valuation of Bitcoin is the price that we look at, and real valuation and real all-time high are based on the condition that it excludes the inflation from the price of Bitcoin. We used the CPI calculator that was provided by the Federal Reserve in their website, and we calculated that Bitcoin should trade at 78K as of June, I guess, or May. I guess it was May of 2024. In order to beat the all-time high in real terms. That would be a real all-time high for Bitcoin. However, currently, the real all-time high is still the November of 2021, meaning that one Bitcoin in 2021 would buy you more goods and services than it would do in March of 2024 when Bitcoin was 74K, $5,000 more than in 2021 November. However, we rarely use real valuations when it comes to the technical analysis of Bitcoin. That's why, again, the picture is less clear, because in real terms, Bitcoin didn't hit new all-time high, but from the nominal perspective, it certainly did. And again, it comes down to your preference. If you are looking from the perspective of technical analysis, most probably you'll look at the nominal all-time high because that's what we care when we do TA. We rarely use the chart of real valuation of Bitcoin. We stick with the nominal valuation for the technical analysis purposes. However, when it comes to purchasing power, that's when real all-time high matters. Because one Bitcoin would buy you more stuff than it in 2021 than it would do in March, even though it was $5,000 more in March of 2024. That's why the picture for the all-time high is less clear, because we have two different methods to calculate new all-time highs. From the perspective of nominal valuation, we already had a new all-time high in this cycle. From the perspective of real valuation, we didn't. However, I believe that nominal valuation matters more because we use technical analysis with nominal valuation. We rarely stick with real valuation of Bitcoin or any other asset when it comes to TA. And in 2019, we didn't have a new all-time high, both in nominal and real terms. We had real and nominal new all-time highs in 2020 and 2021 rally. And in this cycle, in this rally, we already had a new nominal all-time high, not a real one. But as I said, I believe that nominal valuation matters more just because of technical analysis and sentiment. When new retail investors want to come and buy new crypto or Bitcoin or altcoins, whatever, they will not look at real valuation of Bitcoin or some other asset. They'll just stick with the nominal value. So when it comes to investing, yeah, people just use nominal valuation more. That's why I believe that this one goes to 2021 all-time high, because we didn't have nominal all-time high in 2019, but we had nominal all-time high in 2021 and in the current rally. Then we have 21-week EMA, exponential moving average. As we have discussed in that video, when Bitcoin rallies and it finds support at 21-week EMA, it's a good sign. It means that the rally is healthy. It means that Bitcoin's price and valuation are not overextended. And it means that bulls are at control. For example, in 2021, there were at least 3 instances when Bitcoin found support at 21-week EMA. After that, the rally got overextended, of course. And then when Bitcoin plummeted in the summer of 2021, the 21-week EMA didn't hold as support. And in 2019, for example, we had no support at 21-week EMA for Bitcoin. And when Bitcoin started to plummet, and when 21-week EMA didn't hold as support, Bitcoin crashed for another 40%. And the overall correction and drawdowns from the highs was more than 50% in 2019. Currently, we are very close to 21-week EMA. At the time of shooting the video for discussing 21-week EMA, it was above. Bitcoin's price was above this indicator. However, now it's a little bit below of this 21-week EMA. So we are yet to see if we hold it as support or not. However, from the perspective of 21-week EMA, the current rally is more similar to 2021 because we had 3 instances of support. We had 0 supports in 2019 and we had 4 or 5 supports in this current rally. Which means that from the technical perspective, the rally is healthy and it's not overextended. And this one goes to 2021. And then we have the last one, USDT dominance. This one actually is the weakest argument when it comes to the argument of Bitcoin's price action, because it may be just a coincidence. If you watch the video, you'll know what I'm talking about. After all, it will be broken, the trend line, which indicates the local tops for Bitcoin. However, until now, it worked perfectly. 0 errors in the last 5 years. If you just looked at that trend line and you just sold your Bitcoins whenever the USDT dominance went down and touched the trend line, you would just nail it. However, as it's not a horizontal trend line, it's a diagonal one, eventually it will break because we are not going to have 50% of USDT dominance in a couple of decades. Hopefully not. Yeah, it's not realistic. And when it comes to the comparison of these 3 rallies from the perspective of USDT dominance, we have more or less the same outcome because in all 3 rallies, when USDT dominance found support at the lower trend line that we discussed in that video, it marked the local top for Bitcoin. And it happened in all 3 rallies. It happened in 2019 once, then it happened in April of 2021, then in November of 2021. So we had 2 local tops. In fact, November was the cycle top. And we had a local top in March of 2024. And again, USDT dominance found a perfect support in the lower trend line that we discussed in that video. Although we might see some new price action and new all-time highs in the upcoming months and quarters, we cannot deny the fact that March 2024 was the local top for Bitcoin because after that, Bitcoin's price corrected for more than 25%. It was a local top, even if we have new all-time highs in September, let's say. So from this perspective, USDT dominance, again, is just the same for all 3 rallies. So I'll not write, or actually I'll write 2019 and 2021, meaning that we had similar environment in all 3 rallies from the perspective of USDT dominance. So as you can see, most of the macroeconomic indicators indicate that the current rally resembles more with 2019. And there are some indicators which are the result of those macroeconomic indicators. For example, I believe that Bitcoin dominance and Ethereum Bitcoin valuation show that Bitcoin outperforms Ethereum and the general altcoin market in the current rally and in 2019 because we had QT in 2019 and high interest rates in 2019 and in 2024. Because yield curve is inverted in the current environment and it was inverted in 2019. The same goes with gold breaking out. Gold knocked on the multi-year resistance zone in 2019 and it only broke out of it when the environment was uncertain and when we had QT and high interest rates, meaning that investors wanted to move their capital into one of the safest assets. The same happened in 2024. Gold broke out of its multi-year resistance zone when we had QT, high interest rates, and when the yield curve was inverted already. And remember that yield curve inversion is a very accurate sign and signal for a recession. Yeah, it's not perfect, but usually when yield curve inverts, it signals a recession. And usually recessions arrive after the uninversion of the yield curve. So that's why a lot of macroeconomic indicators show us that the current environment is quite similar to 2019. Some people will argue that it's harsher than 2019 because we have higher interest rates in 2024. The terminal rate is 5.5%. It was 2.5% in 2019. The QT that we have now, it's tighter than it was in 2019. In 2019, only 10-year and 3-month yield curve was inverted. The 2-year and 10-year was not inverted. Both of those yield curves are inverted in the current environment, and they are inverted more than they were in 2019. So that's why we see that we only have two indicators indicating that the current rally is similar to 2021 rally. The first one is 21-week EMA, which is a technical analysis kind of indicator. It has nothing to do with macroeconomic conditions. And the second one is the all-time highs in nominal terms. In real terms, we didn't hit new all-time highs, but in nominal terms, we had a new all-time high in March of this year, indicating that this rally is similar to 2021 from that perspective. And yeah, USDT dominance is just the same for all three instances. And when it comes to drawing conclusions based on these similarities and differences, it primarily depends on your preferences and how you think. Because a lot of people believe that monetary policy has almost no impact on crypto assets. And Bitcoin is not correlated to, let's say, equities. And high interest rates and QT will not affect Bitcoin's valuation. And some other people will argue that M2 growth rate will not have a significant impact on Bitcoin. So it depends on the way you think. For example, if you exclude monetary policy, you'll see that here almost all of the 2019 cases will go away because monetary policy was the main reason for gold breakout, for BTC dominance going up, for the yield curve inversion, for Ethereum, Bitcoin valuation. As you see, it depends on the way you think. If you exclude macroeconomic indicators, namely the monetary policy, you can easily compare this rally to 2021. However, there are some people who pay more attention to macroeconomic indicators. For example, I believe that monetary policy plays an important role for every capital market, including crypto, because even if you are bullish on Bitcoin, let's say, you need excess liquidity, disposable income in order to buy more Bitcoin. Who cares if I'm bullish if I don't have extra money to buy more? And if there are no buyers and we have a lot of sellers, the rally cannot continue. And even if it does, it will not be as parabolic as it was in 2020. And remember that in this rally, the macroeconomic conditions were quite the opposite of the current environment. We had quantitative easing, the largest one in the history. We had 0% interest rate, practically zero, it was 0.25. We had 40% increase in the M2 money supply over 2 years. And we had 28% increase in 2021 year over year in the M2 money supply, which was the highest in the history of the US. So you see that from the macroeconomic conditions perspective, this rally was quite the opposite of the current rally. That's why, if you pay more attention to those indicators, the macroeconomic indicators, you will see that this rally, the current one, is not very similar to 2020 to 2021 rally. In fact, it's very similar to 2019 from those perspectives. That's why it comes down to your preference and the way you think and understand the overall crypto market and macroeconomic conditions. And it doesn't mean that if the current rally is more similar to 2019, this is the cycle top, or we are going to have 50% corrections from here, like we did in 2019, or we are going to have a recession that will wipe out all these gains in Bitcoin. No, we just need to stay open minded to the idea that the rally will not continue in linear terms. We may have something similar to a cool off phase that we had in 2019, for example. Cool off phase doesn't mean a correction of 50%. It just means that Bitcoin's price is not going to hit new all-time highs in a few months. And after that, it may. And another thing is that the QT and interest rate decision, they will affect in lags. So that's why if you pay attention to monetary policy, it's wise to be open-minded to the idea that we are not going to have all-time highs after all-time highs in this rally. We may have a cool-off period for a couple of months, and then we might resume and have another local top or cycle top. And after all, we are going to have another QE, maybe in 6 months, maybe in 1 year, no one knows, but QE will return and interest rates will go down and the yield curve will uninvert. And when those things come, Ethereum Bitcoin chart will go up. Ethereum will start to outperform Bitcoin. Bitcoin dominance will go down during a Bitcoin rally, meaning that there is higher demand for the general altcoin market than for Bitcoin. The M2 growth rate will go higher again. It will be close to 5 to 10%. And those are the conditions that we need for the rally like the parabolic one that we had in 2020, 2021. To experience that, and in order to have an alt season, meaning that a few months of altcoins outperforming Bitcoin, those conditions are important from my perspective. So that was the content that I prepared for today. I hope you liked the series. And please let me know in the comments if you are in the camp of 2019 or 2021 and what are your reasons. Do you see some other similarities or differences between these two rallies? And do you have some other reasons to believe that this rally is too similar to 2019 or 2021? I'll wait for the comments. Thank you for watching and I'll see you next time.